Hi, guys. Welcome to another episode of Young Professional African Edition with your host, Jonathan Rwanika.
And Shaneil Mudley, equipping you with all the right tools to jumpstart your career in an African context by sharing experiences
and spreading the gospel of information.
With original music brought to you by Africa's own Shaneil Badiachi. Personal finance is the process of planning and managing your personal financial activities such as your income generation, spending, saving, investing, and protection. In today's episode, Jonathan and I are going to go over some of the tips and tricks that we've learned along the way regarding our personal finances.
Personal finance is a big issue, right? Especially for young professionals in corporate. And often we find that there is some sort of asymmetry of information where people either don't know the best way to manage their own money, or they don't know the best vehicles to use to manage their finances. So today we're just going to be talking all things personal finance, Shaneil. I don't know, do you want to maybe kick us off by maybe key themes that could be important for us to touch on today?
Yeah, for sure. So as you said, I think this is a really big topic for the continent and also in South Africa, given our bad savings culture and given the fact that, I think this pandemic also showed the resilience of an economy who have a good savings culture. Being able to lean on your savings in times like these are one of the main goals of having a good savings plan. So I think some of the topics that we can touch on maybe, setting your financial goals, understanding your financial position quite well, and then maybe looking at the investment opportunities that we've taken or that we've seen along our journey that have been effective. Because I think with so many products out there, so many different companies and so many different opportunities, it's sometimes difficult to sift through everything. So, maybe giving our perspective of what we've seen could be helpful for our listeners out there. And then I think another important one, which I've stayed away from for quite some time, was, using your credit card, taking on debt, either using it as leverage, which would be positive, and then what's the bad side of it when you start using your credit card to buy your groceries on a month-to-month basis?
I think it's very interesting that you note savings culture, and I think you cite South Africa there. I think you shared a very interesting picture on our Instagram page recently, where you actually see that I think Johannesburg is fourth or third on the list in terms of saving culture in Africa, which is surprising because I think for GDP per capita, it should be relatively higher than that. So I think this discussion also seeps into that, like maybe what are the things that we're doing wrong and things that we could all improve on to better our personal finances.
Yeah.
I think maybe what's important to point out here, Shaneil, before we delve deep in the solutions, is that neither one of us are financial advisors. We might both work in financial institutions, but personal finance and the finance we deal with in corporate are two completely different things, different skill sets. So we're just offering things based on our own personal experience.
Yeah, definitely. So I think we're a lot like the listeners. We are on the customer end of things. We're just explaining, what has worked for us along the journey. So we're in no way experts on financial planning.
Yeah. Let's talk about savings culture, Shaneil. Like, do you save 10% every month, for example? Is that a thing that you do?
So I actually do now. I actually save more than that. But that wasn't the case when I first started working. I am doing that now. And maybe we discuss how that journey happened. But at the moment, yes. But it wasn't always that way. How about you?
So I actually use debit orders to do my savings every month. So I actually don't even realize I'm saving until I look into the portfolios that I'm investing in. I'm like, oh, I've actually saved quite a bit because I know myself. there's no way I am transferring money into savings manually every month, consciously. Like that's just not happening, you know?
So, and I think that's where my sort of journey to savings got a lot better. I tried to do that first, where you're like, okay, I've spent this much and this is how much I'm going to save. But the moment I started putting my savings on autopilot and having those debit orders from my account, that's when I actually started seeing, fairly decent gains in my savings.
Maybe just to like really delve into savings culture, what made you not save before you started putting aside this 10% or more? What were the impediments of you saving?
So I do think the culture of South Africa, and this is an extrapolation of my position, but I think once you start earning your own money, you get excited. And if you think about sort of most of South Africa, the backgrounds that we come from, if it's from a poorer background where you haven't been exposed to generational wealth, when you reach a point where you start earning money, the first thing you want to do is spend and start buying stuff. So I think we're all exposed to that in some way or form, or even if it's through your friends. When you see your friends buying cars and start buying nice expensive stuff, you also want to jump on that bandwagon. So the moment you can start doing that, you start doing that. You start buying things, and what you start to realize is like it might be cool for a month or two, but then it sort of loses its appeal.
Yeah, I think the same reasons for me. I think I was also sort of decentivized by the amount that I was saving at the time because I actually think I opened my first mutual fund in university, and I wasn't making a lot of money. I think I was like a tutor or something. Like I was putting aside a small portion per month. But I think I'd started reading things like Rich Dad Poor Dad, so I was feeling motivated, right? Like, oh, okay, let's do it, even with 100 rands. But I think that culture that is we don't talk about that a lot. We just talk about I don't have enough money to save, but whether when you start making money and you haven't created that culture of saving, even with a lesser amount, you'll reach a point where you're earning 3-4 million rand an annum and you're actually spending more than you earn. Like it's possible. Like the things like that actually do happen, so I think people analyze a lot saying like, but people don't have money to save. But I think regardless of your net worth, if you're not creating that culture of saving, it's not going to magically appear as your net worth starts to increase either. So yeah, I think that's one thing that I've learned from my journey. Just start. Doesn't matter. Just start.
Yeah, I
You
think,
know.
and start as soon as possible. That's a very, very important point, I think, that you've made there. That people sometimes feel, at once I'm earning X amount and I can start saving a bigger chunk of money, that's when I'm going to do it. But I think really the way to train yourself to be disciplined in your saving is to put money away, whether it's 100 Rand or 10,000 Rand a month. Really creating that discipline and creating that sort of initiative every month, or even putting it on autopilot, because there's so much tech around us now that you can afford to do that, and that's accessible. And I think that's something
Mm.
that's helped both of us.
Maybe one more thing before we move on from that is I think I read a book once. I'm trying to think which one was it, and they phrased it as you need to pay yourself first. You know, don't think of it as saving. Think of like this is your salary, which you need to pay yourself. That's what savings are. So if you're not paying yourself, but you're paying everybody else, like that doesn't
Yeah.
make any sense, does it? And that for me, that was also an epiphany. I was like, oh, yeah, that's right, right? Like I'm not even paying myself any money. But anyway, I don't know. Maybe a good segue would be talking about the type of products you use, or maybe is there another theme you would want to touch on first before we go into that?
Yeah, so I think before we go into that, I think another important thing to note or to do before you start looking at investments, or anyone starts looking at investments, is understanding your financial position quite properly. So I've actually read a book recently. I think we should try to remember the names of these books and put it in our next Instagram post on the story. But essentially, it has an exercise in there where you literally put out a spreadsheet, you look at what have you spent this month, and then you start categorizing the different spends into like, your essentials, your groceries, money that you just, spend on drinking, on going out, or on having fun. And then you start to see, how much am I earning? How much am I spending? And how much do I need to be spending? So that you really understand what's your disposable income, how much you can start putting away. And if need be, where can you start making cuts in spending in order to benefit yourself in the long run. So I think understanding what money you have to work with or what you need to do on a monthly basis in order to save an amount that you'd like to save going forward. And I think you can even take it. So I'm at a point now where I've even discounted back my cash flows from age 65 when I plan to retire, how much I want to retire with on a monthly basis, to understand how much I need to be saving now. So I think eventually you start doing things like that. Once you get into it, do you really understand that this is the long-term vision? This is what I want to retire with. This is my monthly income that I want. Then what do I need to be doing now in order to sustain myself?
Yeah. So maybe to the audience that's listening now and hearing Shaneil talk about discounting and going like, wow, that's intense. Actually, if you go on like an Alan Gray or like a Signia, they actually have bots in which they can compute. You can punch in a few things like what's your monthly income, and they can actually compute it for you. So it's not, just to maybe give it a bit of more context to people who are listening, it's not something for finance people to do. Like, there are bots that can assist you in doing these things at most of these investment organizations, on websites, etc. So but just to agree on you there, I think categorization of expenses is very important, Shaneil. I think in my personal experience, like I bank with in Investec. I hope they are listening so that they can maybe improve on this thing I'm about to talk about. So they have this budgeting app that's inbuilt within the banking app, but you sort of have to manually input what's groceries, what's transport, and obviously those things keep changing as you swipe your card. I would like an app which like sort of can detect based on what's been swiped and just automatically like pull it into a category, and not give me like the cumbersome admin of typing them one by one. I don't know. Have you used 22/7? Apparently that's another like app that's there.
Yeah, I was about to say they actually do a good job on categorizing stuff automatically. There are a couple of things that are outliers which you'll need to input yourself, but it mostly does everything automatically for you, and it can connect all of your accounts together. So it's quite a useful app. I think the only thing which maybe some other listeners would also feel is around the data privacy. You need to be okay with an application having your statements or your bank balances, etc. So that for me has been the only thing that I've seen or heard from other people that sort of prohibited them. But other than that, the actual functionality of 22/7 was quite good.
Okay, and also about budgets. For someone who qualified as an accountant, I didn't use the Excel budget technique a lot. I only started using it quite recently. I'm actually embarrassed to say, but like now that I actually use it, I'm like, oh, this makes sense. I can see, what's going in and what's going out, and plan better. I think I have a few friends also that like, especially like if you're in a serious relationship as well, or like if you're married, I think it's great to have a joint budget where especially if you're like spending together. Yeah, I think a budget in our experience has been extremely useful.
Yeah, definitely. And then I think that would be a great segue, because once you understand your budget, your financial position, when you do meet with a financial advisor, when you're starting to consider the different investment products, you have a more informed decision, because now you understand how much you have to spend, and you can decide, do I want to be spending it on a life product, on a, as we will discuss now, income protection. You can decide what's actually most important to you based on the budget that you currently have.
Just to piggyback off that, Shaneil, I think it's also important for us to also talk about long-term versus short-term financial goal setting while talking about this, because that's the motivation, right? While you're saving, you need to have a goal. And there'll be a mix of short-term and long-term goals, and that will influence the type of products you'll be using to invest in as well. You know, a long-term goal, like I always used to laugh about this, but I used to have a flatmate about my first year in corporate. I used to have a flatmate called Desmond. And Desmond wasn't even in a relationship at that time. He didn't even have a girlfriend, but he had two education funds for the two kids that he was planning to have. You know, for me, that was a game changer. Psychologically, I was like, what?
No,
Well,
that
that's
is pretty intense.
long-term financial goal setting. You know, that's an example. Term would be like, me and Shaneil, we need to go to Bali next year, you know, and maybe instead of taking out a retirement annuity, we're going to take out a money market account to save, right? You know?
Definitely, that was my attitude as well. It was never like thinking about an education policy for my children.
But you have to think about it, hey. Shaneil, I told you
Yeah.
about the breakdown of Old Mutual. I read an article where breaking down how much it'll take to get a child through private school education and university, and the amount that you need per month to be saving. And those they were ridiculous figures, bro. So it's if you're planning to have a kid even 10 years from now, you probably need to start saving right now.
Yeah, yeah. I think I need to
So,
contact my financial advisor and have a chat.
now we all need to, Shaneil. Oh man. But anyway, maybe types of products, hey. Let's get into the detail. People are listening thinking, okay, so what type of products do you guys invest in and which ones work and which ones in our experience?
Yeah. So another aspect maybe to also just touch on there is you need to think more than just your growth on the product. It's also, what are the fees and what is the tax on the product. So the tax-free savings account. So actually I have one with Signia. And why I like them is that you get a global exposure to different underlying assets or ETFs. So for everyone on the call there, an ETF is an exchange traded fund, which means that you can essentially buy a basket of assets or bonds or commodities that track a specific type of index. So you get like a really good diversification benefit, much like a mutual fund works. So I think for me, the tax-free savings account has been a really, really great investment product that's come out recently to encourage savings in South Africa. What are your thoughts there, Jonathan?
Yeah, so ETFs are funny enough, Shaneil. I also have a Signia ETF. I think I have the fourth industrial revolution that tracks the
Yes, same one.
Is it the same one? Okay,
Yeah.
so why I'm big on that is it's foreign exposure, right? It's very rare for you to have foreign exposure on an asset, especially when investing with these mutual funds when you don't have a lot of money. Like the minimum investments are probably like a 500,000 rand, a million rand. But Signia then just came with these ETFs that track foreign assets, and they are not even actively managed. So you don't even pay a lot in management fee. So right now it's performing like crazy because the rand is
Yeah.
depreciating against the dollar. So even the underlying asset doesn't even matter because you're getting currency gains rather than real gains from the actual intrinsic value of the asset. But I think what's also important for me to point out is the difference between actively managed funds and passively managed funds. So passively managed will be like an ETF, like it just tracks the market. It tracks a composite of whatever the fund is about. Then actively managed will be what a lot of the Alan Gray and Old Mutual products, like those balanced funds, like they pick stocks, right? Right, like a balanced portfolio, and an actual fund manager handles that. They tend to come with a lot of management fees. I think it's like 2.5%. Whereas it's with passively managed funds at Signia, it's like 0.25%. I think what's also key to note is that actively managed funds in recent history have been really underperforming. I think I don't want us to segue into a passive versus non-passively managed debate, but I would highly encourage anyone that's investing to stick to low cost, passively managed funds.
Yeah, I mean, I think when people do their own research, the stats show that over a 10, 15, 20-year period, passive funds always outperform your active funds. So it's there, it's in the statistics. It's something that you can go and research, unless you're a Warren Buffett or a Ray Dalio who's been outperforming the markets on a continuous basis. Most of us go into passive funds, and that's where we see a lot of the gains.
Yeah, yeah, yeah. But maybe when we were having this discussion earlier in the week, Shaneil, we were talking about a third option that I had forgotten, where you actively manage your own portfolio. So it's either it's passively managed by a Signia or actively managed by an Alan Gray, or the third option, actively managed by yourself. You know, and especially for people that are in commerce degrees that want to enter investment banking and areas like that, I think there is significant value in trying to be like a trader, whether virtually using like virtual currency or using like 5,000 rand or less, like just a small amount, so that you get into that technique of analyzing markets, picking stocks, because that's what investment bankers do. And I feel like the assessment to get into there, like your interview, will be something along those lines anyway. So it'll give you an edge, I think.
And I think especially for the non-accountants out there, someone who went, so I myself did my CFA level 1 and went like a finance sort of route. We don't get as much interaction with the balance sheet. And when I started doing my own investment account and when I started managing my own stocks, it forced me to start looking at cash flow assessments, starting to look at the quality of the earnings. So aside from the technical indicators and calculating your different ratios, also then understanding the different parts of the financial statements. What are they telling me? How do I assess quality earnings? And all of those sort of things, which is really, really important. I think if you are looking to move into investment banking, maybe even private equity, I guess, or venture capital. So if you're looking at any of those fields and you want to be doing this, I would even go as far to say is virtual is good to start with, but put some money down, because when you have money in the game, when you have some skin in the game, you really think about things differently. You start forcing yourself to actually understand, like, okay, well, what is this company doing? How are they reinvesting? Because it's your money that's at stake. So I think that's a really important thing for me as well. Because when I had my virtual account, I wasn't putting as much effort into monitoring the market as I did when I started putting in real money.
Okay, so if you have some extra funds, put your skin in the game. Life insurance, Shaneil. Do you have life insurance? What are your thoughts about that?
Yeah, so I do have a life policy with I think mine is with Discovery, and that's just because my car insurance is with Discovery as well. So that's just like, let me link it up. But I think that is something that you definitely have, that you need to have. I think it's one of those things that's a grudge purchase. Almost all insurance products like that is a grudge purchase. You'd rather be investing your funds in more, well, at this age, more risky investments that's going to get you a higher return. But you do need things like your life policy being taken care of in the event that something happens. And that's why I say it's a grudge purchase for me.
Yeah. So when I initially took out my life insurance, I took it out with PPS, and I think I was paying like 200 Rand a month. What really hooked me to that policy was that it had an income protection aspect to it, and it also had a retirement payment part to it. So if I don't die, they pay me out all my premiums plus profits at 65. If I'm not stop working, they pay me a part of my salaries because I'm also paying for income protection, which means that I would also receive a lump sum when I died. And that dynamism in one product was the pull factor. Obviously, as my salary increased, I think the cover also, the premium I pay also has increased, unfortunately. But yeah, I thought that was an interesting product. And
And maybe you just mentioned income protection there. So maybe do you want to just give a breakdown of what exactly that is for anyone who doesn't know?
yeah, so like income protection is for people whose income is you derive most of your income from the work that you do as an individual. So like if you stop working right now, let's say your only income source is your job, Shaneil. If you stop working, then you have no income. It's different from someone who has investment property. Like if they stop working, they break a leg or something, or they can't work anymore, the investment property will still be paying rentals, you know. So income protection is to protect, especially for those single income individuals that derive most of their income from just one type of work, you know. You have to de-risk that by getting an income protection product, which says when that one single source of income stops, I can get like money from my insurance company.
And I think maybe that's a nice, this touches on something that's, I guess, a big culture in South Africa that we maybe didn't discuss as well. How do you feel about property investing in terms of earning passive income from it in the long run? Is it something that you've looked at, considered, something that you're doing? Or for you, is a property more of a, this is my house, so I'm only going to buy it when I'm planning to live in it? I don't really think of it as an investment.
I grew up in Zimbabwe.
The economy was fine, and then just all of a sudden the economy crashed and people lost financial assets. My parents lost their pensions, or any shares that they were holding in listed companies crashed. So I think for me, property, given that context, becomes something that's very significant, because property as an asset, you can just keep it 20 years from now. Let's say the property market crashes, you can just keep it, but 20 years from now, it could recover. Different from a crashed economy like the Zimbabwean example. Like there's no recovering that, it's gone. But our house in Zim is still there, you know? So that's where my property, how, like I haven't started investing in property, but when I do start, I believe property is a good investment because it's an actual tangible asset, and its loss of value is not as much as any other asset.
Yeah, yeah. So I think that's also a very South African approach from people that I've spoken to around, the fact that it's a physical, tangible asset that you have. I think maybe another way of looking at it, the way that I've started seeing it, is that, is this going to be paying dividends to me in the short run? So in my 5 to 10 year period, I don't view it as something that's going to pay me a dividend. So, well, unless you're paying off like a huge amount of money, because most of these mortgages are 20 years to pay it off. So I think if you are looking for investment products that can pay you something in your 5 to 10 year period, then property is not maybe the best investment opportunity. But when you've got that long-term view, and when you're starting to think, what am I going to either leave for my kids or have at retirement, that's going to be giving me income post-retirement, post-working into your retirement, then property becomes a very, very attractive source of investment.
Myself, I don't find value in owning the place that I stay in. Like for me, that's not the important thing here. But I think for me, property is a great store of value.
Yeah, definitely. I would definitely put that as from your perspective, from a store of value, it's a really, really good investment. So I think, maybe pulling out a bit and understanding the themes that came from that. It's firstly doing your budget, but then understanding what is your investment horizon and what do you want from your investments. So if you're looking for a stored value for a lot of cash that you've got locked up in a bank account that's not earning that much, then property, looking at these sort of things. When you're looking at a 20, 30 year, 40 year investment product, your pension, your provident funds, your income protection, your life products, those are all very valuable. But when you're maybe looking at a 5 to 10 year one where you want to go a bit more high risk, I think our discussion around investing in equities, your tax-free savings account, seeing things with higher growth. So I think those are really, if we pull out the themes that we've been discussing at a high level, that's sort of the things that we touched on.
Yeah, maybe for the audience, the next big question will be, what are the big mistakes that you've made, and mistakes that maybe people have made, in sort of a way, in sort of like a segue in us extracting lessons.
Yeah, definitely. So I think for me, one of the biggest ones, and I think I even realized it with you, started in university. I started saving or started looking at investment products quite late. So the first thing I would say is start as soon as you can, whether you're at university, if you're deriving any source of income and you can afford to put away even 100 Rand a month, I would start doing that as soon as possible, just to instill that savings culture. That's something that I think I could have done better. Another thing, which if you do decide to manage your own portfolio in equities, so it's quite a specific mistake, is not pulling or not withdrawing funds consistently or over the short term. And the reason I say that is because of tax. It's straightforward, just because of tax. If you're going to pay the same amount of tax for taking out 100 Rand today and then taking it out in 5 years from today, rather pay it off in a longer period of time where you've able to accumulate more money or more capital gains with that money over the long run. So I think that has been an important lesson for me, not taking out your cash too early, leaving it for the long run, and simply because of the tax implications.
Yeah, you know what I'm getting from all this. Sorry, just a quick note. I'm just like, there's a lot of tax and accounting and finance like themes. We're not even explaining them, because like we're just like just assuming. I think some advice that I could give, because like obviously I have an accounting background, you have a finance background, so like our understanding of when you talk about capital gains tax, like I didn't even blink, right? I totally understand what you're talking about. But reading those, especially those books like Finance for Dummies, or I think there's a book like called How to Manage Your Money Like a Fucking Grown Up, those type of books, to just give you like the themes, not to like understand advanced tax like I'll do, but like just to understand tax at a very basic level. But anyway, mistakes. So the biggest mistake that I made was also, I think I started saving late. Not having long-term financial goals for me is also a big one, and not utilizing budgeting tools like a budget early on. I think I started a bit late on those things. But yeah, are there any crazy financial mistakes? I think I might have, spent a bit too much money on a trip, maybe in Europe a couple of years back. But that happens sometimes. Like you plan, you're like, I'm gonna spend this much money, then you go and you spend too much money.
But I actually, I don't think I'd count that as a mistake, eh? And the reasoning behind that is there was this whole thing that we learned in economics once about a reservation price. And when you understand the value of an asset or the value of something that you buy, so for example a car or a chair, it depreciates over time. Most assets are depreciating over time. But when you're spending money on experiences, the more you look back at it, the more you discuss it with your friends, and the more like you talk about it or think about it, the value actually increases over time. So I think if you spend it on a trip to go somewhere, then it was money well spent from an economic point of view. If that makes you feel any better, that's sort of how I view it.
Yeah, a little bit. No, but I don't even get what you mean. Like experiences are important, and I think that mistakes like those ones are actually, we look back and laugh about it. You're like, Jonathan, that, and it's great, the great story to tell. So you're right. You're perfectly right. But yeah, those were my mistakes that I can think of off the top of my head.
Yeah, so I also just thought now from sort of discussions with other people, I think another one is maybe keeping all your money in one place. That's dangerous as well. So whether you're just keeping everything in a bank account, everything in a money market account, everything in one investment type of product. I think especially at our level and at our age, and if you're not so experienced with picking out things and you're not doing research 100% of the time, diversify your portfolio. That is obviously the advice that's mostly given. I do think if you're somebody like a Warren Buffett and you can afford to do like research on one stock or one specific stream, and you know for certain that this thing is, that this is valuable, then by all means go for it. But if you're just the average corporate, average youth in the corporate, and you're looking to get into different things, move your money around a bit, because you never know if a fund is going to collapse or what's going to happen in the future.
Yes, and I think for me, not just that diversification should be multifaceted. So diversify the currency you're exposed to, diversify the stock exchange you're exposed to. South Africa, in terms of stock exchanges, I think JSE in terms of value is 1% of total global stock exchange value. So you understand, even if you're diversified in South Africa, you're actually not diversified, because you're like in 1% of the entire population of financial assets. So foreign exposure is great. If any one of the listeners knows of ways to expose your portfolio to foreign assets in a cheap way, like how Signia does it, please share so that we can share with everyone. I think foreign exposure isn't something that everyone can easily access for some reason. I don't know why. But if there are more assets out there that we could do that through, please let us know and we can share.
So I think just to maybe summarize the episode, the first thing that we spoke about is financial planning, doing your own personal financial planning, understanding your current financial situation and your current financial position, and knowing on a month-to-month basis how much extra cash you have to spare that you can put away. Having that extra cash, I think the best thing to do is put your savings on autopilot. So have those debit orders structured appropriately so that it's going directly to your investment accounts without you seeing that money from the get-go. Another key aspect, I think, is that in terms of investment products, it's quite evident that Jonathan and I both have a tax-free savings account that gives us global exposures. So Signia was the one that we use. Another thing is income protection and having a good life policy in place. And I think the overarching theme around diversification was quite apparent, not just in one asset class, but across a diverse group of different distinguishable variables. So across your currencies, across your investment classes, diversify as much as possible. And lastly, active versus passive. In the long run, if you don't have the time, then I think that looking at a passive approach makes a lot more sense for you. Having a passive approach also reduces your fees, and overall in the long run, we have seen statistically that passive funds have outperformed the actively managed funds.
Thank you for tuning in to this week's episode of Young Professional African Edition. If you haven't already, please subscribe to the show on Apple Music, Spotify, or whatever platform that you use to listen to podcasts.
And if you enjoyed the show, give us a like and a follow. Find us on Twitter and Instagram at YP_Africa. That's YP_Africa. And if you've missed an episode, don't stress. You can catch up on our YouTube channel, YP_Africa. Like and subscribe, guys. Like and subscribe.
That's it from us, guys. See you next week.